If you are in the buy-to-let property game, one thing is for sure, you need to know your numbers. In this video, we're going to figure out exactly how to analyze your next property deal so you can work out the monthly cash flows, the expenditure that you have on that property, the profit that you will derive from that property each and every month, as well as looking at the long-term capital appreciation potential of your property. One thing that I've learned in property is while the monthly cash flow is really nice, it's really nice for your asset to be paying you every single month, where you truly make your money in property, it's on the long-term capital growth of your asset. Let's figure out how to analyze a property deal so that you never have to guess whether you have a good deal or not. You can plug in the numbers and you can figure it out by using this strategy. All right, so I am here on RightMove. This is where every good property search begins, at least if you are here in the UK. And let's say that I'm looking in a particular area that I like to invest in, which is Crewe in the northwest of England. Fantastic yields, good fundamentals, and this is a place where I own a couple of properties that do really, really well. So I have plugged in a couple of numbers at the top here. So I've plugged in a house. I'm looking for a house, not really bothered if it's detached, semi-detached or terraced. I'm looking through a 3-bed because I want to get a family into this property. Families are fantastic tenants. When you get a family into your property, generally they are there for the long term compared to maybe a couple or a single person or a student or somebody like that who is going to probably live in your property for a year or two and then move on. For families, you can have those kinds of tenants in your properties for many, many years. And the price point that I'm looking at here, I've plugged in 180 to 250. Let's put that down a little bit because there is some amazing value to be had in Crewe. Let's go from 150 up to 220, let's say. And I'm going to plug in and look at what is on the market, newest listed. And what this will do is pull up a list of properties currently in the area that I can look at. And I actually haven't looked at the market in Crewe for a couple of weeks, so this will be quite interesting. I may even find something that I quite fancy investing in here. But let's have a look. So we have here, this looks pretty nice, doesn't it? Broad Street in Crewe. Let's have a look at this property. Reduced today, so that's quite a good sign for me as an investor because it means that they have been struggling to sell the property, which means they may well be open to an offer. So this is in Broad Street in Crewe, quite central. It's a semi-detached, 3 bedrooms, 1 bathroom, freehold property. And let's have a little look through these pictures. So that looks pretty nice, pretty modern. Looks to be in quite a good state of repair. I know these kind of properties in Crewe, they're old, but they're well built. And the garden's not too bad. It's in a pretty good condition from what I can see. Give us a little bit more information here. The EPC on that property is not loading. Let's have a little look. So that's failing to load right now. But one thing I would do would be looking at the EPC of that property to see what that is like. But basically, this is quite a good property on the surface. 180 in Crewe is, it's not bad for a 3-bed, spacious 3-bed in the center of the town, walking distance of the town center, as we can see here. So let's start plugging this in to our analysis. So we have here, I'm going to jump into my BTL ROI calculator. So my buy-to-let ROI calculator. This is what I use for every single purchase. And if you comment on this video and if you want this spreadsheet, I'm more than happy to send it over to you. Drop a comment in here. If I get enough comments, then I will make this spreadsheet available to whoever wants it. But this is what I use for every single property that I purchase, which gives me an idea of whether this property makes sense or not. I will quite literally use this spreadsheet to make a decision on whether I want to purchase a property or not. I've even done this without looking at properties. I've asked my agent to go have a look at the property, make sure it's in good condition, and I've plugged my numbers into here. If it checks out, I'm ready to go, ready to invest. If it doesn't, then I'm not. So let's start having a little look at some of the numbers on here. So to begin with, we have the purchase price. So I can update this into here to 180,000. And what that's going to do is change my deposit. So in the UK, at least, The standard procedure for buy-to-let property is a 25% deposit and then a mortgage on the rest of that. So here we have a property at 180 grand, which means a £45,000 deposit. Let's have a little think about some of the other costs involved in purchasing this property. So we've got purchase fees, which is going to be solicitor, which is probably going to be in the region of 1,000, 1,200. We've got the surveyor, we've got the marketing for that property when it actually goes to market. I like to actually add that in to my initial calculations. So the marketing for getting that out for the rental market and the charge that your agent will give you for that. And then we've got mortgage broker costs. So we're looking probably at 1,200, 2,200. Let's call that 3,500 all in. I think that's quite reasonable for the initial costs. Stamp duty is going to be 3% of this number here. So what we can actually do, sum of this number here times 0.03, that's going to give us our stamp duty cost. And then refurb and furnishings, to be honest, it looks like this property does not have any work that needs doing, at least on the surface. So I think we're actually good there. I don't think there's anything that needs to be done straight away. So we don't need to put anything into that. But if there was, for example, something that needed doing, new bathroom, new kitchen, anything like that, then we would, of course, update that column with the amount that needed doing. So from there, we're going to start to actually research the market in terms of rental. What could we expect to get for rental on this? We know it's going to cost us $53,900 to get into this property. But what can we get for our return? Because this will dictate whether the property is worth investing in or not. So I'm going to go back onto RightMove here, but instead I'm going to look at property to rent. And again, I'm going to go into crew, to rent, number of bedrooms, 3 we're looking at. Property type, houses. And we're going to plug that in. And then we're going to go from newest listed. And what this is going to do is give us an idea of what the going rent in the market for a nice property in Crewe. So as we can see here, this is a pretty nice property. That's a detached. So I'd say that's a little bit nicer than the property we're actually looking at right now. That's going for $1,250. We can see this one here. I would say, looking at the images here, fairly similar, maybe not quite as nice actually. And we can also look at the location. It looks like this is quite central in Crewe as well. But we can start to get an idea, basically, of the market. So we've got 950 here, we've got 1,300 here, we've got 850 here. This property is definitely not as nice. This is more of a terraced property in not amazing condition. So that's going to be below what we could expect to get for this property. But we can start to get an idea, and we can start to get a ballpark range of what the properties are going for in that area. So to me, this looks quite similar. Semi-detached, 3-bedroom, similar state of repair. So does this one. So looking at this, 1,000 per month, 1,000 per month, 1,000 per month. These properties look fairly similar to the property that I am going to investing in. I could go a little bit deeper. Obviously, we're going to run out of time if I go too deep into the research today. But one thing I would do if I was doing this in my own time would be to actually look at the street and try and find other properties on that street. But let's say for the purpose of this video that the rent we can expect is around £1,000 a month. That looks quite reasonable based on these other alternatives. So I'm going to plug that in now into my rental revenue per month. £1,000 per month of rent. So obviously I need to update these numbers because these are all going to be skewed off now, but I can start to plug in some of this as well. So I've got here a repairs allowance at 10%. Now looking at this property that I've just or not just purchased, but that I'm looking at purchasing, it looks in pretty good state of repair. So I think we can afford to put that down to 7.5%. I normally like to guess somewhere in between of 5 to 10, depending if it's a new property or an old property. If it's a really, really new property, I'll go 5%. If it's quite an old property, I will go 10%. And if it's somewhere in the middle, I'll go 7.5. So I think it's fair in this occasion to put in 0.75 here, which means I can expect a repairs allowance of about £75 per month, which is probably going to happen in 1 or 2 installments. You know, something needs doing, you know, a shower needs replacing or something like that that's going to cost me 200-300 quid a couple times per year. No service charges because this is a freehold house. If it was a flat or an apartment on leasehold, there probably would be some kind of service charge or ground rent. Insurance, I'm going to put in £15 per month. That's about what I can expect for this. And then management fee, you may or may not need this number in your calculation, depending on if you get your properties managed. Personally, I like to get my properties managed because I have a fantastic agent who just takes care of everything for me, so I can focus on my other businesses and looking for deals and whatnot. So we're going to plug that in at 12%, which is 12% of the rental revenue. So that is what my agent charges, which I think is about at the market rate for what you should be expecting. 10% plus VAT is his charge, which I'm happy to pay for the great service he provides. And then the final one here is mortgage. Now, mortgage, we can work out, actually, there's an app that I recommend that I'm about to plug in now. I will pop this on the screen for you, called Mortgage Calculator. If you type that into the App Store, I use this. It's quite a handy little tool. But if we're purchasing the property for 180, that means that we need 75% of that to be mortgaged, which gives us 135 grand that needs financing. And let's plug that rate in at 6% because I think that is what we can reasonably expect right now in the market. So let's plug that in at 675 per month, which is what that gives us on an interest-only mortgage, which is generally what I recommend. I could do a whole nother video on that, but I tend to recommend interest-only because it will give you a better cash flow, and also your debt is being eroded by inflation over time. So if you hold that property for a very long period of time, the 135 grand debt that you have on it today is going to be a very, very different situation in 10, 20 years because of inflation. So let's have a little look at the numbers. So what does this tell us? So essentially we have the rental revenue at 1,000. We have our total costs at 885 per month, which gives us a gross profit per month of £115. And that gives us a post-tax profit, which I've worked out based on having your properties inside of a limited company where you're going to get charged 19% corporation tax. It gives us a post-tax profit of £93.15, which gives us a net rental profit of £1,117.80 per year, which is an ROI, a return on your investment, the return of this 53,900, an annual return of 2.07%, which is not very good. I'll be honest. That is not a return that I would find acceptable for any property that I invest in based on the cash flow alone. So what this is initially telling me is probably this deal is not worth pursuing. However, there is one other thing that we need to be looking at here, which is capital gains. So I've put the capital gains in here at 3% per annum, which is conservative, especially for the Northwest, where actually we've seen rates of capital gain quite a bit higher than that the last few years. But I think it's really important, and I've put this here as the first tip on this sheet, is to always run your numbers conservatively. I think it's really, really important to not overestimate your numbers because you want to make sure that you're being conservative so that if anything does go wrong, you have that margin of safety. Really, really important. So I like to have that margin of safety. This could well be 5% per annum, but for the purposes of this deal, I'm going to put it in at 3%. And that essentially gives us this number here of annual total profit from the property. If I add in the net rental profit and the capital gain that I'm likely to receive on that property, is £6,517.80. I just jumped off there for a second because I wanted to add in actually another little row in this sheet, which is the total annual ROI, when we actually factor in the cash flow from that property every single year, in addition to the capital gain, the appreciation of that property, because that's going to give us a more accurate idea of how that property is performing. And actually what we can see here is that the total capital appreciation of that property is going to be £5,400 per year, most likely. And remember, we run these numbers relatively conservatively, so I'm quite confident that the property will increase in value by about 5 grand a year on average. And then we can also see that the net rental profit is 1100-ish per year, which is not mind-blowing, but it's washing its face basically. So what I would say here is that when we actually look at the total ROI of this deal, the total annual ROI, we are looking at a 12% return, which is not actually too bad. And this is what I find often with properties, is that if it isn't an amazing performer when it comes to cash flow, it can be quite a nice performer in terms of capital growth. Now, 12% return on your money, I think, is quite solid over the long term. And for this reason, it would make me consider this property a little bit more. However, I would quite like to get a bit more on the cash flow. So what can we do to actually make that happen? Well, the main thing that we can do is negotiate on price. So this is what I would suggest at this point, is that we really need to be looking at having a conversation with that vendor. Now, they have put on this property offers over, but in this market, which is relatively soft at the minute, that doesn't always mean offers over. It means they may well be open to an offer. So let's say that we could get this property, we could get a 10 grand discount on this property. So I'm going to revise my numbers here and pop in 170,000 into this for the price. Let's say we do a bit of negotiation and we figure out that we can purchase this property at 170,000. Now, this means that we'll have slightly less debt on the property. We will actually have 127,500 on the mortgage because it brought down the deposit to 42,500. Let's say we're still at that 6% interest rate. What that means is it's brought our mortgage down to 637 and 50p. So that now brings the ROI on a cash flow perspective to 2.9%, which is getting a little bit better. Personally, I quite like to see a total ROI of 5%. Remember, this isn't yield. I actually think that yield is quite a weak number to be looking at when estate agents will say, hey, this is a 5%, 6%, 7% yield. Take that with a pinch of salt, because it doesn't factor in the costs associated with the property, and it also doesn't factor in tax. So this ROI is the net ROI after all of your costs and after you've paid your tax. So that's something that's really, really important to remember, and that's why I like this sheet, because I really am coming to the net ROI. So at this point, we're at a 2.9% return on cash flow, and that brings the total ROI slightly up to 12.88% and a 6.5 grand annual increase on our asset when we factor in the cash flow in addition to the asset price. Now, what else can we look to change with this to make the numbers a little bit better? Now, I don't recommend just like placating the numbers to a point where you're like, this is going to be a good deal now, because we need to be realistic still. But looking at the properties for rent, is there any scope that we could get a slightly higher rent? I'm not sure based on what we have here, because these 3 beds, there is quite a range, but some of these properties are going for closer to, 1,200, 150 and whatnot. And actually, I do own a property in Crewe relatively similar to the property that we have here that is currently rented out for £1,075 per month. I think there's a good chance that we could get to 1,050. We could increase that rent by about £50 per month. So let's see what the numbers say when we do that. Again, I don't want to go too aggressive here because we need to be conservative with our numbers still. But let's say we put that into 1,050. That increases our annual profit to 1,873 on an annual basis, and the ROI to 3.6%, and the total ROI with capital gain to 13.65%. So the numbers are starting to look a little bit better now. I think this property could achieve 1,050. I think that is realistic. The gross profit per month now is at 192, which is a lot better than we originally had. And now this deal is starting to look a little bit promising. So this is the science. I've gone through the maths. I've gone through the science of analyzing this deal. But here is where we bring in a little bit of the art into property investing, which is the art of the deal, the art of negotiation. So let's say that I can start to drive a little bit of a harder bargain here. The market is quite advantageous, and I managed to get myself this property for 165,000. This is where the deal starts to look a little bit better. If I start to plug in my numbers again, so 165,000, 75% of that, means that I have 123,750 to mortgage. Plug that in at 6%. That brings my interest-only mortgage down to £618.75. So I've pushed this deal about as hard as it can go now. This is kind of like a best case situation where I managed to get a really, really good deal on this property, a good price, 165 grand. I get top of the market rent, and I factored in a lot of my numbers here. This property is now delivering me a gross profit of 211 per month, a post-tax profit per month of £171, and a net rental profit, which is the profit that I'm making after tax every single year of 2 grand, which brings the ROI to 4.14% on a pure cash flow basis, which brings the total annual profit plus CG, that's capital gains, to 7 grand, which gives me a total annual ROI of 14%. Would I do this deal at 165 grand? I think I probably would, to be honest. I think this is now looking quite attractive. And I think what I'm going to do is call them up and see if they would be open to an offer on that property. Or maybe I'll just keep an eye on it, actually. I'll keep an eye, because if this stays on the market for a couple more weeks, the vendor may well get to a point where they really want to sell. But as I can see, this is in quite good condition, immaculately presented according to the estate agent, and it's got off-road parking. It ticks a lot of boxes. So for me, not a bad property. I know these are solid houses, so I may well keep a very good eye on this and consider making an offer on this property. It would be good to see the EPC. I don't know why this is not working on the RightMove website right now. It's a little bit annoying, because that is something that I think is important to understand, the energy efficiency of that property. It's not as important now that the government have scrapped the requirement to go to a EPC-C, which they originally did state that they wanted to do. But I think it's still good to purchase a property in a good state of repair, and energy efficiency is a part of that. So my next steps from here would be, if I wanted to go ahead and make an offer on this property, would be to go and view this property. And if I felt that it ticked all of my boxes, I would put in this offer of 165 grand. I would say, look, take it or leave it. This is my offer. I'll leave it with you. If they came back and accepted that offer, then I would proceed with purchasing the property. And importantly, I would get a survey on this property just to understand if there are any other refurb or furnishings, because if there is any money that I need to spend on this property to get it up to scratch, to get a tenant in, maybe there's some damp in the property or something like that. If I find that out, that's going to completely change the deal, because say if there is some damp in the property and that costs me 10 grand to sort out, that throws off the deal a little bit. It throws off the ROI. It brings our total ROI down considerably. So it's really, really useful to know if there's going to be any issues with your property before you purchase. Super, super key to know your numbers. This is the most important thing in property, is understanding your numbers. And RightMove have a lot of tools where you can figure out if a property deal is viable. And one thing that we haven't even touched on is actually another indicator of the capital appreciation of this property. Is you can go firstly on the property sale history. So as we can see, it's done quite well. It's they purchased this property in 98 for 34 grand. 2011 it was sold for 69,500. 2018 for 110. So we've seen 104% gains over the course of 13 years here, and then over the course of 7 years we saw a 58% gain, and now this property is up at 180. So it's looking like the capital appreciation of this property is performing quite nicely. So that's quite good to see. But then also what we can do is look at similar properties that have been sold nearby, and as we can see here, sold properties, it's going to bring up other 3-bed semis nearby. We have 180 grand here for this property here, 156 here, 185 here, 207 here. So you can start to get an idea of within the local vicinity, what are other properties selling for. If this was all like 120, 130 grand, then I would say this property is way overpriced. But because I'm seeing 185, 180, 156, but that property looks like it maybe needed a bit of repair needed. We can have a look at this one here. Oh no, it's in quite good condition actually, but not quite as nice as the property we're looking at, is it? So, you know, this makes me think that, okay, if we can get this for 165, actually I'm getting a good price based on what else has sold recently in the area. So again, hope this was helpful. This is exactly how I analyze a property deal. And you have to be a detective in this game. You have to really figure out, you know, what are the numbers, what are the ROIs looking at, what are your costs going to be, what is it going to bring in rental, and what is that ROI, and have some rules for yourself around ROI. Personally, I do like to see things getting close to 5%, which means I still may need to negotiate a little bit more of this property, or I may need to see if there's any way to increase the rent, or if there's any other creative ways to bring down the costs of this property, the monthly ongoing costs, maybe mortgage rates improve, something like that. You make your money in property when you buy. Remember that. If you buy right, if you buy at the right price, if you understand the numbers, you understand the ROI, you understand the long-term capital appreciation, then you are in very good stead to do very well from that property deal. But this stuff is crucial. So again, if you want this spreadsheet, if you want this Google Sheet, then I can ping it over to you. Just comment, and my WhatsApp is going off. I think my agent is coming to me with some more deals. So until next time, all the best and take care.